Welcome to This Week in Money. I'm Jim Goddard. Today, Wall Street Windows trader Mike Swanson talks about gold's breakout. Canadian Securities Exchange CEO Richard Carleton on how small companies can navigate capital markets. First Vancouver Finance Vice President Tom Klausen feels Dragon's Den is a poor business model. We talk to Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is trader Mike Swanson, founder and chief editor of WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me.
You were telling us that gold is going into a new bull market. It's about time, isn't it?
Yeah, well, it's kind of funny. I'm looking at a chart, a 20-year chart, and it looks like what we've seen the past 2 or 3 years has just been a pause in a bull market that's been going on since 2001. And I think we're turned the corner. If you look at things a little bit more closely than this 20-year chart, I tend to break the market up into 4 stages. The second stage is a bull market, which is what everyone is familiar with. That's when prices go up and you get little pauses, they go up again, and that's what's been going on in the U.S. stock market since March of 2009. But then you get a topping market where prices tend to go sideways, and they're actually inside the market. Individual stocks and sectors are rolling over, and the structure of the market's actually being negative, but most people don't see that because the indices keep going up or seem strong. And then the fourth phase is a bear market. And the thing about these phases is it's easy to identify what phase you're in if you use the long-term 200-day and 150-day moving averages, because in a bull market, those averages act as support, and in a bear market, they act as resistance. So, for example, the Dow dipped just the other week and hit the 150-day moving average and is bouncing off of it. So it has held up as support. One day it'll become resistance, and then we'll be in a bear market. But I don't know when that's going to be. But the important thing, though, for gold is those moving averages, and for the gold stocks too, were acting as resistance in 2012 and 2013, and that meant gold and metals were in a bear market, and they crashed last summer, and since then they've been going sideways in what I call a stage 1 base, which acts as a prelude to a new bull market, and when the basing phase happens, these long-term moving averages tend to flatten out. Now, what has happened, though, is last week, the HUI and the XAU, the two major mining stock indices, broke out and closed above their 200-day moving averages on Monday of last week. And to me, that signals that they've completed this basing phase, and they are now in a new bull market. And then, to confirm this, gold and silver did the same thing last Friday. They closed above these moving averages too, and had big jumps. Now, a lot of people, I've been saying this on my website, and a lot of people don't believe it because, frankly, gold and the mining stocks had fallen so much for 2 years that we've seen so many false rallies that people are used to that, and no one wants to make any more bets, and they're scared. But I think, that's also what you see right when a new bull market starts, is people don't believe it. And then one other thing that confirms to me that this is something really big happening is that it's not just gold and silver that has gone up, the commodities across the board. The CRB, Commodity Research Bureau Index, has broken out, and if you look at, just chart out different commodities, you'll see that they're not all breaking out in a single day, but they're breaking out some before, some did it a month ago, some are just doing it, and they're surging through these long-term moving averages. In fact, just the other day, coffee prices went up 12.5% in a single day. Well, that's just the sign. It's just, this is a new big trend that's developing in the financial markets.
So everything rising at once, or close to it?
Yeah, pretty much. The commodity complex as a whole is turning up. That doesn't mean all commodities are going up to 12% a day, but some of them are surging, and natural gas has done it. Oil prices aren't going up like that. I don't think they will, for some time. But what's noteworthy, though, is these big moves are coming off of these basing phases. It's typical of a start of a bull market. You get a big move right at the beginning. So, if you look at the gold stocks, for example, if the HUI were to go up to 290 or so, that would be almost an over 20% move from the lows. The percentages can be so big at the start of a new bull market because you're coming from such depressed levels and coming out of bases that have been going on for quite some time.
What's to stop the U.S. or China, per se, from selling off a bunch of gold again and dropping the price like what happened in June?
Well, I don't think, I don't know, I didn't know they even did that in June, but I don't think, I don't see why they would do that now. But even if they did, one thing that's important to understand is that bear markets are driven by selling, okay? And they come to an end not when all of a sudden everyone starts to buy, but when there aren't any more real sellers left. And the basing phase is a sort of a transition period, but the gold stocks and gold, they're not going up simply because all of a sudden today everyone is buying it. It's that there's simply so few people left in these markets to sell because they've already done it. So even if China were to sell some, I think that we would have enough buyers in these markets to take those shares. And, you're going to get your dips and pullbacks anyway in any market. So I'm not saying this is going to go up every day, for the next couple of years. In fact, I think, we can see the HUI get to 280, 290 or something, and then, pull back 5 or 10%. Maybe that's when China would be selling. I don't know.
The Elliott wave. What is that? And should we be scared of it? Can we surf on it?
Well, the real Elliott wave theorists, they claim that you can predict what the market is going to do using a mathematical formula. They claim that the market moves in 5 waves, which are essentially 3 bull markets and 2 bear markets. This is a trend over years. But they claim that you can calculate where the tops and bottoms are and the duration of these moves using a mathematical formula. I don't believe in that. But there are some aspects of the theory I think that are interesting. And one is the way they talk about the psychology of a market. They claim that the last wave is like a bubble bull market where everyone gets all excited and there's a lot of speculation and stocks essentially or the market essentially goes straight up. It's something like what we saw in internet stocks in the 90s and real estate 8 years ago. If that were to happen with gold, it would mean gold could go to $4,000 to $10,000 an ounce, and the gold stocks would go parabolic, like they did in the late 70s when they last made their giant top. I think that could happen, but not because I believe in the mathematical formula they use. I just think that, in a sense, that's how long-term markets work. A secular market trend is one that lasts over 10 years. And even though the stock market, the Dow and S&P have done well the past couple of years, the NASDAQ has made a new high recently, I think we're in a secular bear market trend that started in 2000. And those type of trends usually end with stocks at a cheap price on a fundamental basis and widespread disgust and bearish sentiment. Well, a bullish secular trend is one that lasts over 10 years. And if you believe in LA wave theory, we had a bull market from 2002 to 2008, or a wave, I should say, from 2002 to 2008. That was wave one. Wave two would be from 2009 to 2011 or so. And we would be coming up on the final wave 5, which is supposed to be the speculative blow-off wave. Well, I believe we're in a secular bull market, and they end in such waves, so I think we could easily be seeing that over the next couple of years. This could be the final giant run for the gold and, and mining stocks, which, like I was saying, people don't believe it. They don't even believe we're in a new bull market, so that really sounds far out to most people listening.
Is the Fed a perpetual bubble machine? I know markets hate bubbles.
Well, I think what the Fed does, or has done since the 1970s, is it tends to lower interest rates to try to stimulate the economy, and then you get a bubble forming somewhere, it blows up, and then they lower rates again or print money, as they do now, to try to stop a recession, and they end up creating a even bigger bubble than last time. So you could say that as a result of the 87 stock market crash, the Fed lowered rates and tried to do things. The result was the S&L crisis a few years later. They had to respond to that. A decade or so after that, you had the long-term capital management fund blow up and speculative bubbles in bond markets and currencies around the world. They lowered rates. They created an internet bubble. That blew up. They lowered rates again. They created a real estate bubble, which, of course, was bigger than all the other previous bubbles. It blew up. Now we are at a zero interest rate policy, and the Fed printing, over $70 billion of money out of thin air to try to help buy up mortgages and fund the deficit. However, I think they've created a bubble bigger than any of the previous bubbles, perhaps even put together, and that's a bubble in the Treasury bond market, which I think could bust wide open in a couple of years from now, and that would be an explanation for why gold is in a bull market now and why it could eventually one day go parabolic.
Is China hoarding gold because they believe the U.S. probably won't pay all of its loans?
I just think they're being smart, and gold is an excellent hedge for that. Now, I don't think the United States government is not going to pay. They're going to pay. The question is, though, are they going to pay by using a cheaper dollar than what the dollar's worth now? And I think that's very much possible. So if that's the case, I think gold is a smart hedge against the declining dollar. So they've essentially covering that risk factor.
Is there a website where people can explore more about your thoughts and theories?
Oh, sure. It's wallstreetwindow.com. wallstreetwindow.com, all one word.
Coming up, Richard Carleton on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Richard Carleton, CEO of the Canadian Securities Exchange. Welcome to the show, Richard.
Thank you very much. Wonderful to be talking with you.
Many people are just finding out about the Canadian Securities Exchange. You've been around for a few years, but of course, someone might say, well, doesn't Toronto do everything? Well, Toronto feels they do. But I think, Richard, maybe people should know more about the Canadian Securities Exchange and maybe just find out, what are you doing to make yourselves more popular and perhaps more public?
Well, basically, we aim to be, and this is not unusual in the early stage capital space in Canada, but a 10-year overnight success. The organization, as you mentioned, is based in Toronto, and although we have an office in Vancouver and we have representation in Calgary and Montreal as well. In fact, I'm coming to you from our Calgary office today. But we're an organization that has gone through a number of changes over the years. But at our core, our mission, our mandate as a company is to lower the cost of capital for entrepreneurs looking to raise money from the public capital markets in Canada.
And what is the big difference between the Canadian Stock Exchange, for example, and the Venture Exchange?
Well, I'll correct you there. It's the Canadian Securities Exchange,
right.
But
yes, the Canadian Securities Exchange. Yes,
and this our listings model has been consistent throughout our entire existence over the last 10, 11 years, and it reflects an important philosophical belief that we have about the investment process in Canada. Basically, we are concerned that entrepreneurs, companies that are looking to raise money are going through a long and expensive process with the traditional exchange model in Canada. And what happens is that in addition to various steps designed to reduce or address regulatory risk, such as taking personal information forms from all of the officers and directors and insiders of the company, and reviewing their background and track record in the public capital market space. We also look at the company's financials to make sure that that again, as a private company, they've been keeping appropriate and proper financial information. But once we've gone through all of the steps that are required, what we don't do, and what happens on other exchanges in Canada, is a close review of the business. We don't second-guess the business acumen of the entrepreneurs behind the company. We don't act as an additional director in the boardrooms, which is a line that I've heard a number of people use to describe the approach of the other exchange. And what we rely on, however, is really the wisdom of the investing public and the power of the communications technologies and social networks that are in place now to give people the information necessary to appropriately price the securities, to render their decision, by buying or selling, whether or not they like, what the company's up to, whether they have confidence in the management team, whether they like the business plan or the prospects for growth of a particular company. And, that's how markets work. And, we believe that in leveraging all of these networks that are in place, the chat rooms, the the broadcasters and communicators such as yourself, to provide information for people, that is going to reflect itself in, a proper evaluation of what the company is about and what their prospects are, not people sitting in an office building in Toronto or Vancouver or Calgary.
I've heard that for a small company, a junior minor or technology company, if they go to some other exchanges, more than 75% of their funds end up going to regulatory bodies, lawyers, brokers, examiners. And by the time you want to go out into the bush and start looking for your latest diamond mine or whatever, you have very little of the money that you actually raised.
Well, that is really the benefit of the approach that we have, is that we do enable the companies to maximize the amount of money that they have to invest in their business, not, as you say, pay their lawyers, pay their advisors, and frankly the exchange and the regulators to get listed. It's really all about lowering the cost of capital, which, as we say, enables these companies to invest in their growth, not in the regulatory regime.
As I said, for these people, either setting up a lab, say you're a tech company, or if you're a mining company, finding the funds to go out there into the wilderness and find the new resources that Canada relies on to keep the economy moving. How can they access this, new markets for money and new investors? Is that the whole idea behind the Canadian Securities Exchange?
Well, in addition to, as we mentioned, reducing the cost of capital by the approach that we take, and not engaging in the lengthy and detailed business review, or again asking them to restructure the financing or so on. We also work with the companies to help them tell their story. So, for example, on our website at www.thecsc.com. Each company has 4 pages that are dedicated to giving not just the basic facts and access to the filings that they've made with us and on the CDAR facility, but also an opportunity for them to provide more information about the company, what they're up to, what if it's a technology company, what their vision is, what their niche is, what their direction is. Mining companies obviously want to talk about the asset that they're looking to explore and potentially convert into a producing mine. We aim to do what we can to help the companies tell their story to the investing public.
Someone mentioned they had trouble accessing quotes when they wanted to know about new accounts or how their account was doing. How does the access to accounts work for your exchange?
Mm-hmm. Well, as a startup exchange, that has been one of the key areas of focus for us, is to ensure that we provide as broad access to our information as possible. And it has been a challenge over the years, in particular with the bank-owned discount brokers. We had a lot of resistance in the early days from that group to providing both trading services and market data, the quotes, through their facilities. As time has gone on, however, we've begun to break down those barriers, and we expect by the middle of March this year to have all of the discount brokers, including the bank discount brokers, save for one, with market data and trading access through their online services. But one of the other things I should mention is that the data is also available through numerous facilities that cater in particular to the retail investing public. And last but not least, we have real-time data available through the Google Finance portal. So you just simply have to go to google.com/finance, punch in the quote, or at least the symbol that we've assigned from the CSE, and you'll receive not only a top-of-line quote, but also news, charts, analytics, the ability to establish or add to a portfolio, do comparative analytics with a peer group, very powerful information tools available to investors for free.
And they always say information is money. I mean, for so many companies, in fact, I saw a study that up to 60% of an average company's assets are information. we always, people wonder, how could a hacker ruin a company? Well, if information and what you know and what you hold is worth that much, I think you can see how things could get upset if you didn't have access to that instant information you're talking about right now.
Well, and that's really what I talked about, the power of the model that we have. And by ensuring that there is as much information about our companies, and again, one of the unique features of our market is each company has to provide a monthly update from management on the activities of the company in the previous month. And so they provide that, and it is distributed through our web facility. And I believe a number of third parties pull the information from our website and publish it through their facilities. And again, it gives investors an opportunity to understand, is this a company that's in maintenance mode? Are they actively pursuing an exploration program or a research and development program on a particular technology? Have they hired anybody? Have there been changes on the board of directors? Are there new investors? Has there been a private placement or, some other financing done? Again, it's an opportunity for people to have as much information as possible about the company so that they can make an informed decision on its valuation.
Is there any hostility between the traditional exchanges and your exchange? Because it seems to me you're using the very, very latest high tech to keep everybody in the loop.
Well, no, I can't say hostility. In fact, I worked for the Toronto Stock Exchange for a number of years, admittedly in the last century, and a number of our team members with the firm have a background with the other exchange group in Canada. So I can't say that in fact we're there's any active hostility. What we're working to do here is provide entrepreneurs in Canada with a better model for raising capital in the public markets in Canada, and to provide them with the tools to tell their story, to broaden their shareholder base, to facilitate additional capital raises, and otherwise support the capital formation process here in Canada. And as you mentioned earlier, this is where job growth and economic growth comes from primarily. It's these small businesses which are growing and contribute to obviously not just the wealth of the owners and the founders or so on, but frankly across the country as investors are able to participate in the growth of these companies.
And keeping small companies healthy and active, very important for everyone, I think, too, is the average person may not be aware that small companies are actually the job engine of the country. The major corporations aren't the ones who provide all the jobs. It's small business. These little guys who are just trying to get going.
Well, exactly to your point. And it's genuinely one of the most satisfying parts of my job when I visit with companies that have chosen to list on us. We see them 6 months, a year later, and they've gone from 3 or 4 people in a shared office space to having, their own space. They've got 50, 100, 150 people that are working. I can think of a couple of companies, Recess and Generate, which are based in Vancouver, are growing just tremendously. But, as a parent of 2 20-something kids that are trying to break into the job market, and I look and I see at those companies 20-something, recent graduates from, wonderful Canadian universities with, great technology skills, able to work and grow, their own experience and skills, and to see them, able to, find meaningful work shortly after graduation is just a tremendous story.
Richard, are there some websites where people could go to find out more about the exchange, or maybe just to find out, how they would stack up against your business model?
Well, as I say, I would encourage your listeners to visit us at www.thecse.com. And as mentioned, we have extensive coverage from our friends at Google. And virtually any of the services that cater to the retail investing public in Canada do provide, good broad coverage of the services that we provide and the companies that list with us.
Thanks a lot, Richard, for chatting with us.
My pleasure. Thank you very kindly.
After the break, Tom Klausen on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Tom Klausen, Senior Vice President for First Vancouver Finance. Welcome to the show, Tom.
Thank you, Jim.
Today, we're going to be talking about what does First Vancouver Finance do. I know you help out emerging companies who are looking for financing, and it's probably one of the hardest things you can do besides coming up with the idea for your company is where do I get the money now to explore, expand, and make that idea become reality. Tom, what's your first piece of advice to some small company who comes to you looking for finances?
I think knowledge of what the alternatives are available out there before you proceed. I think that a little bit of investigation and study, talking to some people, and knowing what your options are. It's, sometimes confusing. I mean, it is confusing, and a lot of different people would talk to you, but there's, ways to find out and simplify it. It's not that complicated when you really look at it.
Everything's that way when you really look at it.
Yeah.
But when you're a rookie, when you're first introduced to the big leagues of anything, it's pretty confusing. Mm-hmm. What's the first mistake people usually make?
Well,
or one of the big ones?
Yeah, I mean, to starting a business, it's always the initial inertia. And then, I think a lot of people when they're just starting out, they think that all they have to do is come up with the idea and then somebody will jump on board and finance it, and then they go, straight to the dragon's den and they're wealthy. And the reality of it isn't quite that way. Other people might head straight to the bank thinking, hey, that's what they're there for, and I've been a client of theirs and I've been paying fees and I have a mortgage and I have a car loan and they should be able to help me. But as soon as you mention business to them, it's a different matter. And there's confusion in there. Sometimes the bank will lend you money, but it's not based on your business. It's based on your personal credit rating, your net worth, your assets, that sort of thing. And so people get confused with that, not even realizing that this is a personal loan and not a bank loan. And then when they get into their business, and they may, tap out those sources, they go back to the bank and say, okay, here's my business, it's succeeding, and how am I, I'd like to make a bit more money because I've got orders now and I've got sales now and things are looking great. They can be sorely disappointed because the bank says, sorry, I mean, you don't have any more personal net worth, and we never really were lending you money against your business anyways. And then they get into trouble. And that's the problem. And that's where I come in. It's sort of it's that interim financing. It's when those businesses find themselves in the betwixt and between, which is basically stuck in the middle of something and don't know where to go. So there are what we call asset-based lending alternatives available to businesses and to small businesses even. And this is a form of finance that was previously only available to the very largest businesses, but due to the nature of the economy, et cetera, that is now being made available to the small business owner as well. And there's a number of different forms of that, but in general it's a factoring, spot factoring, full service factoring, accounts receivable financing, and purchase order financing. So a good business, and I have to preface this by saying I'm an expert in finance, but only in non-retail type financing. So your B2B businesses, your wholesalers, distributors, manufacturers, B2B service companies like janitorial, security companies, temp agencies, that sort of thing. Retail is not my forte. And so really knowing what is available during those troubled times and not making rash decisions is what I would think is the most valuable thing somebody can do ahead of time, so they know what their options are, for when they meet and run into those difficult situations.
Tom, would it be a good idea for an emerging company to talk to someone like First Vancouver Finance before they start dealing with banks and perhaps make some fatal mistakes right up front?
Absolutely. And, I spend a lot of time working with bankers, trying to educate them and let them know what our alternatives are. If your banker refers you to an alternative finance person, now you know you got a good banker. And he'll be able to, they refer businesses in trouble to me because they want to bank them later on down the road. And, the banks today are just, to be frank, they're not charging enough money. They're not charging enough interest in order to take any risk. And they consider a small business to be extremely high risk. So the only way they can deal with a small business with an interest rate of 3.25% is when the risk is basically eliminated. And that means you have to have collateral, you have to have net worth, you have to have an A1 credit rating. And that's just not, every business owner just doesn't have that.
So after you've bypassed the banks, where do you go to get your money?
Well, there are only two ways to finance a business: debt, equity, and then a third way, which I call do-it-yourself. And a business owner that's patient can finance themselves. They can grow their business by building up net worth, equity internally, by basically making a sale, getting paid, taking the profits, and keeping that in the business. And then building up your working capital, your net worth from within. You can only do, an exit strategy, you can either, strive to become bankable, strive to become self-finance, or strive to be sold. And you sort of need to know which direction you want to go. It's called, it's an exit strategy. And if you know where you're headed, or where you want to go, and then you know what the tools are available along the way, then, now you can achieve that exit strategy.
What about these young startup high-tech companies that get snapped up by Google or some other entity like that for billions of dollars when you didn't even exist as a company a year ago?
Yeah. Oh, yeah. It's a great phenomenon. And, that goes straight into equity. That's called straight into your exit strategy. And it does make sense for some of these businesses in that field to aspire to that. It's a straight, that's all they're trying to do is create the idea, create the market in many cases, and then basically patent some sort of, program and brand it and sell out. I mean, that is, and then start on a new one. That is perfectly good. That is, generally they are pre-revenue companies. They haven't even generated a sale. And, but they've generated some type of, software. I'm not an expert in that. I could, happily introduce you to people who do that kind of thing. And there's a whole market out there, trying to take you public.
More with Tom Klausen next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're talking to First Vancouver Financial Vice President Tom Klausen. I'm thinking about BlackBerry right now. It's their software that's going to save the company because obviously they didn't know anything about retailing this stuff.
Yeah, and there you go. You do what you're good at, and you don't try to be all things to everybody. And sometimes, if you're in retail, you're in retail. If you're in wholesale, maybe you should stay in wholesale. If you're in, software development, maybe develop the software and then you rely on somebody else to take you out and to market your product. Know what you're good at.
One of the interesting headlines I saw for one of your papers was selling into the U.S. is easier than you think. Because I know we look at that big, scary economic monster to the south of us and you wonder, how do I get in there and will I be eaten alive by all the competition?
Mm-hmm. No, and that's the truth. I deal with companies that go through that all the time. And first off, I don't think I have to explain what an exciting market it is. 10 times the size, and wealthy people, and they like to buy. They make quick decisions, all that stuff. They love new things, and But a small Canadian business that wants to get in there, you have to be careful. Prepare yourself before you go in. Know what's available to you. Many cases, you don't know, you don't expect that big order. You can go down there. And immigration allows you to enter into the U.S. to market your products. And then there are companies that will help you to store inventory, fulfill orders, and then a company like mine that will help you to ascertain the credit of your buyers and to provide you with the cash flow you need. But be prepared before you go in there, because you walk into something and the next thing you know, you get an order for $1 million, and you go back and wave that to your suppliers and your other people, and they say, we can't finance that. The banks are not that enamored with a company expanding into the U.S. and creating sales like that, and rapid growth. It's a danger to them. But if you know what your options are ahead of time, it's definitely the place to expand your market. Before you go to China or Europe or South America, I would say you try to get into the United States first.
Right next door. They're friendly to Canadians. They know who we are. We speak the same language. That helps, more or less.
Yeah, absolutely. And business is the same. It's conducted very much the same way in the U.S. as it is in Canada. And conversely, the banks are exactly the same, and you cannot get a bank to cross borders. So you basically enter into the U.S. without a bank supporting you. You have to do it on yourself, do it on your own.
Even though Canadian banks do have a lot of business in the U.S., and they are business entities there, you have to start all over again with them?
Basically, yes. And part of the reason is just the legal framework. Assets located in one country, trying to repossess from another country, very, very difficult and difficult to manage. The Canadian banks have certain things that they can require, such as insurance, credit insurance, and these other things, but they are basically what we call thumb-sucking devices, and they just add to your expense, but you don't get credit as much for your foreign assets as you do your Canadian ones, if you're dealing with a Canadian bank.
What's the biggest problem that Canadian businesses run into when they expand into the States?
A lack of working capital, not prepared. They may have a nice line of credit up in Canada, and everything's going well, and then they go into the U.S., and next thing you know, it's expanding quickly. They go back to their Canadian bank. They ask for an increase in their line. The bank says, no, we can't do it. You're not ready. Show us another year or two of successful operations. And so now, and people, credit is extended down there. When you sell wholesale to a customer in the U.S., they are expecting net 30 or even net 60 type terms. You have to be prepared for that. The orders are bigger. They require, good quality, delivered quickly, and to the quality that they expect, and you have to do it. And they expect to get 30 or 60 days to pay you back. And that's the challenge. How do we do that? That's where a company like myself comes into play and can help you with that.
I understand, Tom, you're not a big fan of the TV show Dragon's Den.
No, I'm not. I can't watch it. I let my kids and wife watch it, and they tell me if there's any good businesses on there. But to me, there's a situation where they are giving away a significant portion of their business before they've even matured. And you'll notice that they talk about, what's the valuation of your company? What were your sales last year? And then the valuation is based on some sort of formula based on sales. And I say to them, well, if you'd only come to me, we could have got those sales up even higher, and that just exponentially increases the value of your company.
Plus, you don't have to give them 51% of it, or 60 or whatever they demand.
33, because once they're into your company, and once they have any equity at all, then they're basically privy to your business operations, and should you expand, should you grow quickly, should you need more working capital down the road, they have a say in that. They have a sign-off on that. And they can decide whether or not, basically they could say, we'll give you the money, I'll give you the money, and then they're going to require, what are they going to require? You guess it, more equity. And so it's a slippery slope, in my opinion, but I'm a firm advocate of using what you can ahead of time before you utilize equity. There's a saying out there, if you value your business as zero, then use equity by all means.
Tom, is there a website people could go to take a look at some of the ideas you have on how small businesses can get up and going and be, successful right out of the gate?
Yeah, it's frankvictorfrank.ca, our website, www.fvf.ca. We've got a number of articles there. They can contact me directly. I can put them in touch with people that they need. There's a lot of sources out there for young, new entrepreneurs. The Canadian Youth Business Foundation is an excellent source of funding. Small Business BC has some great information down there at the waterfront. And, there's lots of material on our website and information I can send them as well. If they'd like to contact me directly.
Thanks to our guests, Trader Mike Swanson, Richard Carleton, and Tom Klausen, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.